Marc from ADM Investor Services International with some thoughts on commodity markets this week, partly due to the continued strength in gold prices, partly due to the UN FAO OECD annual 10-year projections for agriculture. And just wanted to share some thoughts on what's going on and how they reflect on the performance of the global economy. So my first chart today is of the spot gold price against the US 10-year yield. And it really tells us why, in many senses, why people are investing in gold. And the very simple answer is not because it's a safe haven, but because the opportunity cost of holding gold, i.e. the fact that it doesn't generate a yield, has been reduced to almost nothing because the returns on US 10-year yields, and I could have put in any G7 government bond yield here, they would have all basically showed the same picture. We've got yields at super low levels and no one's expecting interest rates to go up. And so naturally, the opportunity cost of gold has gone down very sharply. And people have looked at it and saying, well, with negative rates around so much of the world, why not invest in gold? Indeed. My second chart today is in the metals sector, and really sort of to just point some things out about how there's been quite a lot of divergence previously between aluminium, copper and iron ore prices. But most notably of late, there has been a particularly strong outperformance by iron ore. That is less a projection about the global economy and far more about the fact that China is basically going to invest very big in infrastructure projects, which benefits above all iron ore, to a certain extent copper, and we've seen huge amounts of demand there. Nevertheless, it's interesting that in the most recent developments, having had a very strong rally in the May through July, early July period, we are seeing some tailing off, which doubtless has to do with some concerns about the rapid infection rate spread that we're seeing and the concerns about lockdown. Also this week, we've had the UN OECD-FAO food price report. It basically still has the same projections as before. It sees demand overall basically fairly flat outside of two specific sectors. In the livestock category, they expect most of the growth to come in pork and in chicken, or poultry, I should say. That should actually be mostly driven by China, but also by countries elsewhere. And as we can see, basically, they are projecting in nominal terms a very, very small increase in food prices, but nothing close to the peaks which sparked the Arab Spring back in 2010, 2011. And in real terms, a small decline. And that's been a projection for quite some time. So how does this pan out in other terms? Well, I think, first of all, just the general reminder with my fourth chart, which is corn versus wheat, that those projections are long-term ones and basically ride roughshod over intra-year volatility. And that's really all I'm trying to show with US wheat and corn prices, that corn certainly depressed by the oil corns. So how about elsewhere? The other thing I think which is interesting is to see how price shocks actually evolve. So first of all, we've got in my fifth chart, US live cattle versus lean hogs. Hogs obviously had a big rally last year because of the African swine fever outbreak, but have since tailed off. And meanwhile, cattle have basically benefited to some extent of late due to large-scale slaughtering going on because of expected low demand. Now, interesting in this is basically comparing that with wholesale prices in China for chicken and pork. As one can see, chicken mirrored pork to initially when we got the big price shock from the Asian swine fever. But in the meantime, as pork production or pork imports have replaced domestic production, so pork prices have remained high, but chicken prices have tailed off and are no longer seen as getting a big boost from demand displacement. In any case, just some food for thought there, and until next week.